Hi, this is Scott Murray, and welcome to the Daily Economic Market Chart for Tuesday, April 18th, 2023. It's actually tax day. Uh, housing. Housing markets still seem to be on a wobbly foundation. We got a little improvement in housing starts, little improvement in permits. Yes, single family permits and housing was up 2 months in a row for both categories. Something we haven't seen a lot, but we're running 20% behind last April. So yes, higher interest rates have taken their toll. Affordability is still the question mark out there. And we are seeing, the builders have, gotten the message. They had significant, sometimes in the order of 50% cancellations in their first quarter or end of last year, earlier this year. And that, I think, sent a message. 30% of builders are lowering price. That's a healthy sign. The price lowering could either be through incentives or through lower interest rates or options or things like that they can do with the thing. So yes, a little more traffic, up to 45. That's a 7-month high for the housing index, which is a look at building activity, or I should say, new model activity, what the builders are saying about traffic flow to their models. So that's a good sign, but it's not translating into construction. Why is that? Well, first, I think we still have this higher interest rates. It's moving down, kind of creeping down to 6.3% long-term 30-year mortgage. That's not bad, but historically, but it's still kind of sticker shock there. And I still think the banks are being somewhat leery about new lots and those types of things that are working through, because you look and you see completions, and completions are, especially on the single family side, are kind of stuck. We would expect, if things were supply chickens were really getting better and labor shortages were getting better, we would definitely see better numbers in completions, and that would then start triggering more starts, building off some of the permit activity we've seen lately. So still sort of a logjam. The other logjam we would note is the high concentrations, concentrations of activity in the South. 40% of activity is not in the South, which tells you that still the work from home mantra, the taxation issues, those types of ability to migrate to different parts of the country and work remotely is still very appealing to people, and other housing markets are struggling to kind of come up with a kind of a shtick to kind of encourage people to stay in those areas. And so concentrated, lack of supply, inability to complete is really sort of still the mantra we've seen over the last year. And that needs to clear. And by clearing, then that will start the new activity. And the new activity is desperately needed. Existing home inventories are very low. We're starting to see a little bit more activity, but pricing is on the edge, meaning that, we could see pretty quickly, if we get any surge in demand, we could pretty much see pricing going back to where we saw. And lately we have seen the pricing costs come lower. And so I think those are very, very helpful signs. And I think those signs would really encourage that activity, but it's not there yet. We'd like to see inventories higher. We'd like to see people list. We'd like to see stable prices. So on the edge, wobbly foundation. Yes, some good signs with mortgages, a little bit more interest, completion still being a struggle, but it could reverse very quickly, meaning that these encouraging signs could dissipate, especially if pricing or interest rates continue to be elevated. This is Scott Murray for the Daily Economic Market Chart. Thanks for joining me.